Thank you for joining this fifth era webinar. We're going to get started now. The purpose of the next 30 or 40 minutes is to talk about some of the most important tailwinds that we think we're going to see as investors, but which are also shaping the future world in which all of us will live. And as we'll talk about in the next few minutes, Alice and I have described this as a fifth era, and we'll explain why we've used that phrase. But we will talk more specifically about some of the characteristics of this new world that we are transitioning towards and why it provides fundamental challenges for existing businesses and also opens up the opportunity for enormous wealth creation for those people who want to lean into it and take advantage of it. The key themes that we'll be talking about are in this book, The Fifth Era, which Alice and I published a couple of years ago, and which we're now making available as a free download. So if you're interested in learning more about what we'll be covering today, please just visit fifthera.com/ebook and you can download the ebook for free. But the reason we wrote this book is we felt that these tailwinds are important for angel and venture investors in particular, as well as entrepreneurs and established companies, because the world is moving through a period of unprecedented innovation and wealth and value creation into a new, very different type of economy, connected globally and digitally. And it's important and incumbent upon all of us to understand it if we want to be active in this time frame and benefit from the direction towards which we're all flowing. In order to really get a keen sense of where we are, it's worthwhile going backwards and looking at where we've been. And without taking too long over this, there are some important themes that are noticeable if you go back and look at the four eras that human beings have passed through in the past. Tens of thousands of years ago, we were all hunter-gatherers, and we lived in small tribal groups. We hunted and lived off the abundance of whatever we could kill and take home, and we might also gather fruits and berries and nuts and other things. The typical unit size was 100 people or less. There really wasn't any wealth, not least because we didn't have technologies to allow us to store the abundance that we were gathering in. And so as a result, through those tens of thousands of years, there was little in the way of wealth creation, and most people were roughly equal. That changed because of the arrival of some disruptive technologies. And we know in retrospect that the domestication of plants, the animal husbandry that allowed improved types of animals, and irrigation were three of the most important disruptive technologies that allowed the world to move into the agrarian era. But what also happened in that change was that wealth for the first time was created. Wealth could be accumulated, and increasingly large empires and kingdoms were established where someone at the top became extremely wealthy through the efforts of those people who were in the fields and farming the land. Now that wealth creation transfer persisted for several thousand years, and we saw the growth of enormous empires such as those in China and in Egypt and Mesopotamia and other parts of the world. But they too came to an end. And they came to an end for a large extent because of, again, the creation of some disruptive technologies. We saw the age of sail, cartography, navigation, and certain other techniques such as joint ownership companies spreading risk that led to the mercantile era. And merchant cities and merchant princedoms were created. And we saw the movement of goods around the world. We call it the pre-Columbian exchange today. But we saw the animal husbandry and domestication benefits of each continent shared between them. And of course, we also saw the sharing of less positive things like diseases that moved from continent to continent. The wealth was captured by a new breed of mercantile empires, and increasingly we saw European nations such as England, Spain, Portugal, and the Italian mercantile kingdoms gathering in much of the abundance and the wealth. If that wasn't clear enough that disruptive technology is the underlying theme, we saw that again just 200 or 250 years ago when the creation of mass production, new forms of energy, including steam and coal and eventually electricity, and the forms of the corporate form of organization were established, and we moved into the industrial era. And once again, the people that held wealth in the prior period were to a large extent destabilized, and new people gathered in the wealth. And in this case, it was the industrial tycoons and the financial organizations and individuals that backed them. And we saw an enormous wealth creation of the last 200 years, but it moved out of the hands of the mercantile families to a large extent and into the hands of the industrial organizations. So if you take those themes, this is fundamentally what we have, that disruptive innovations drive the transitions between the eras through which humans have lived. Wealth creation opportunities have surfaced on a massive scale during each of these times of transition. The prior winners may not be the best positioned, and in fact, in each of those cases, they were to a large extent pushed out of the way by new people who lent in to the disruptive technologies and took advantage of them, even as entrepreneurs, either as entrepreneurs and business owners or as the people that backed them. And we believe those themes are very relevant today, and we'll talk more about that on this webinar. We believe that we are moving out of the industrial era. We are not beginning the fourth industrial revolution. We are actually exiting the industrial era, and we're moving into a new fifth era, which has as its hallmarks a number of things that we'll cover off in the webinar. And most central is the fact that we are operating now with a fully connected digital world, and that is opening up new ways of doing business on a scale that we've not seen before. Now, sitting beneath that are a number of innovations. On the one hand, we have the joint innovations of the life sciences revolution and the digital revolution driven by the internet, but there are a mass of other innovations too. And whether we talk about a few of them here, artificial intelligence and big data that's allowing us to gather insights and take actions on an enormous scale, whether it be the Internet of Things and the sensor revolution that are opening up not only the notion of connected individuals, but of smart connected devices and networking together of everything that humans create, or the next generation of the internet itself with an increased focus on cybersecurity, or the life sciences revolution with its emphasis today on personalization and gene alteration. All of these things and many others are compounding at the same time, and we are in an unprecedented era of innovation, as we'll talk about. This is what we call the fifth era, and the purpose of this webinar is to explore some of the things that are going to be different in this future, because we think that they are tailwinds that should also influence our investing and our business activities. So what are the 10 themes that we're going to focus on today? The first is an entirely digital world, and we're going to talk a little bit about that transition. It's something we've written about and talked about a lot in the past. The second is the rapid global market adoption of new innovations. This is a substantial change driven by point one. Thirdly, we'll talk about how consumer choices are exploding, and the other side of that coin, that competitiveness is increasingly important. Fourth, we'll talk about how some of the underlying assumptions are failing that gave rise to the way we do things today, and we'll give a couple of examples. And we'll also emphasize as a standalone point that the very notion of work is shifting, and we think it will continue to shift, and that brings enormous implications for the adoption of virtual in everything that we do, and it also potentially undermines the corporate model that we've lived with for all of our lives, and in fact that the world has used for the last couple of hundred years. We'll talk about how private capital is capturing the bulk of the value that's being created, and this is in marked contrast to the industrial era when most of the value was captured in the public markets. And then we'll talk about why we think sustainability is very important in this context. And we will also talk about the move towards distributed innovation as a final point. So these are the 10 points, and for the rest of this webinar, we will talk to each of these for a few minutes. So first, let's talk about moving to an entirely digital world. This is something we've spoken about a lot in the past, but over the last 20 years, the biggest single wealth and value creator in the world, bar none, has been the arrival of the internet and the connecting together of human beings. And based upon the TCP/IP protocol, today we have a communication network that puts together 5 to 6 billion people and allows us to share all of the world's information in close to real time. The connectivity is quite remarkable, and it's across many different types of device. It provides accessibility to people, and in fact, most of you will be listening to this webinar through real-time connected devices as we speak. It can allow for a great deal of interactivity, particularly around communications, and the flexibility of the internet provides many different purposes and use cases, and most of us are familiar with those in all aspects of our life today. The scalability has been good too, so that almost every industry or in every geography relies upon the internet backbone that we've been building for 20 or 30 years. The problem is that that internet backbone was meant to be a communication platform. It was not constructed, and TCP/IP was not meant to be a commerce platform. And as a result, it has some very substantial issues embedded in it. The first is that it's insecure. The professors that put together the TCP/IP and the World Wide Web protocols didn't think that they needed to make them secure because they were about academics speaking to academics. And as we've seen, the global rise of cyber security and hacks and spams and phishing is accelerating at a great rate, and that is a substantial threat to the continuing usage of the internet that we have. The internet also has no notion of identity embedded into the protocol, so we rely upon trust that we are communicating with who we think we're communicating with, and that they're sharing the content and it's arriving in the form they sent it. But really, a commerce platform has to have identity and trust embedded in it. It has, of course, become increasingly concentrated. And this is why all of the world's most valuable companies today are technology companies. In America, the Alphabets, Amazons, Apples, and also Microsofts and Facebooks. In China, it's the Alibabas and the Tencents that have become the world's most valuable companies because they have concentrated a lot of the economic activity occurring over the internet through their own platforms. And then finally, and for us very importantly in our investment thesis, the internet of today relies upon old world payments and old world assets, including paper-based processes, and that simply can't make sense in a truly digital economy. So the next 20 years, we believe that the investment thesis is going to be heavily driven by fixing the internet that we have, and that means making it more secure. It means creating new forms of identity and trust. It probably means a greater reliance upon distributed work and distributed networking, and it certainly requires the creation of native digital payments and assets. And so these are tailwinds, these are fundamentals as we transition to an entirely digital world. Now, secondly, because of that connection of several billion people, we've also seen the steepening of adoption curves on products and services globally. And so this page from BlackRock just simply maps out many of the inventions that we all use today and how long they took to get close to 100% adoption. And so going back 100 or so years, the telephone and electricity and cars and the radio took almost 50 years to get to 100% or close to 100% adoption. None of those things actually have 100% adoption even today. But contrast that with the innovations of the last few years, HDTV or social media or smartphones or tablets. These things became almost ubiquitous in a matter of years. And it's hard for us to remember, but the iPhone didn't even exist more than 11 or 12 years ago. And yet today, everyone in the world relies upon their smartphone, or at least more than half of the world's population use something like a smartphone. So these steepening of adoption curves are again a tailwind for those businesses that can create products and services that speak to a global audience, because there's no limit on the degree to which the total addressable market can become global, or at least only minor limitations. The third point, and associated with this, is that consumer choices have exploded. This is just a very simple map of Amazon's stock keeping units, their unique units, available on each of their websites around the world. And so to take the two US bars, today they have more than 500 million SKUs that you can go and buy right now at Amazon.com. That is enormous consumer choice. And it's made possible because, of course, a digital platform allows anyone with a product or a service to make it available to anyone in the world. The flip side of that, of course, is that it also engenders enormous competition. And so the tailwind is that if you have a product, you can get it to market. The headwind is that you're going to have to be highly competitive. And in fact, in many areas like music and film and books, the unleashing of everyone's creativity have also led to the reality that only a tiny percentage of products succeed. So there are two sides to this particular point. Fourthly, the underlying assumptions upon which many of our today businesses and behaviors are built are beginning to fail. And we use here as one example that happens to be in the press a great deal right now, and that is the model of the university, but there are many examples that we could have chosen. In the case of today's university model, it was essentially created more than 1,000 years ago when the University of Al Qarawiyyin became the first university in the world in Fez, Morocco. The university was created because of some assumptions, and those assumptions were that knowledge is scarce and very few people have that knowledge. And those people are people who are learned, they know how to read, they know how to write, they know how to teach, and most of us do not. So if we want to understand the world's secrets, we as scholars have to cluster and go to those people who have the knowledge. And so we do that physically by visiting them, in this case in Fez, Morocco. So you go to them to learn, and physical learning is best. They know how to teach, and they teach you one-on-one or in a classroom setting, and we call that a university. That approach continues today. However, the underlying assumptions are today broken. Knowledge isn't scarce. All of the world's information is essentially available at a few keystrokes through the internet of today. That means that most people have access to the information if they know where to look for it. And in fact, most people do know how to read or write. Even in the areas of the developed world, literacy rates are fast approaching 100%. Scholars, as a result, don't need to cluster together anymore. They can interact with each other digitally, and in fact, they have been doing so at an increasing rate, even though they ask their students to come to them. And it's also not necessarily true that physical learning is best. In fact, the millennial generation, the digital first generation, are beginning to show the behaviors in which they find digital learning to be more effective for them than classroom learning. And in fact, if you go to a modern university and you look out over the audience of students watching a professor, most of them will be online doing other work simultaneously. They simply find it easier to work electronically. Why is this an important example? Because right now in this 2020 pandemic, 100% of students globally are learning virtually and digitally. And that raises fundamental questions for the university model. Why do we still need a physical university model when today professors are demonstrating the ability to pass on their knowledge electronically and scalably as well? So this is an example, but the reason it's such an important example is because it shows that the underlying assumptions of the industrial era activities that we have inherited have today been undermined by the technologies that we've been unleashing for the last 30 years. Now, the same is true of work. The concept of work that we live with today didn't exist before the Industrial Revolution. It was the Industrial Revolution that led to the notion that most of us need an employer, typically a corporate employer. We need a place of work. We need a boss. We have defined work hours, 40 hours perhaps. And typically, at least in the West, those will be Monday through Friday, 9 till 5, unless we happen to be on a shift of some description. There are other assumptions that we live with, that we only have one job, that we are loyal to that job job takes care of our health needs, our insurance needs, and potentially also our retirement needs. All of these are assumptions, and they were the assumptions that drove the industrial era, because the industrial era relied upon the corporate model of business and needed workers that could go to factories and manufacturing facilities and so on to do their work. Today, there's evidence that almost all of these assumptions, again, have been undermined. We are seeing a counter movement away from urbanization, which is particularly accelerated in this pandemic, where we have some of the world's largest companies announcing that they will have remote and dispersed workforces. We're seeing an aging population without the guarantee of future social security benefits, as the social security systems of the industrial era have ended up being insufficient to meet the demands of a growing and aging population. And so there are the needs for older people to continue to be active and employed later in life. We're also seeing, of course, a hyper-connected workforce, and a workforce, at least the millennial workforce, which is very open to doing multitasking and having a portfolio of activities that they use to maintain their way of living, to earn their money, and they're willing to do that in on-demand economy ways, or indeed in simply parallel processing across a variety of activities and projects and businesses at once. Where exactly this ends up, we don't know, but what we do know is there's enormous investment opportunity and potential by building companies that enable the future of work rather than the continuation of the past of work. Now, the adoption of virtual everything is obviously a key piece of this, and we've already made this point, but we'll emphasize it right now by turning to three specific industries. These are all industries that have been or in the process of being transformed by digital technologies. The one above is old news today. If we went back 20 years ago, we were just beginning to undermine the movie industry, the TV industry, the book industry, the press and newspapers globally, and of course the music industry. All of those forms of creative industry were reliant at that time on physical distribution. Today, none of them are. All of them are digitally enabled. And in fact, we've seen the emergence of the largest of all, which is video game and interactive entertainment, which is today the largest creative industry in the world and is 100% today digitally enabled. So that story is an important story, but it isn't defined by that industry specifically. If we look at the healthcare industry in the bottom left-hand corner, for decades now, innovators have tried to launch telemedicine, and they've always run into the headwind of providers saying that it wouldn't be effective at meeting the needs of patients. Today, as a result of this pandemic, telemedicine is becoming ubiquitous, and the benefits of telemedicine are becoming obvious to patients and providers. For patients, instead of waiting perhaps a week to get an appointment where you'd go into an office along with other sick people and wait for a doctor to see you and diagnose you, today you can dial up and in a matter of minutes interact with a provider who perhaps you've never met before, who can listen to your symptoms and at least give you some guidance almost instantaneously. And it turns out that doctors and patients like this approach too. They don't necessarily want to be shackled to having to be in an office every day seeing patients. If they can get rid of a lot of the inefficiencies and do a lot of the pre-screening digitally. So telemedicine is here, and it's driven, and the adoption curve has been driven to almost ubiquity because of this pandemic. In the right-hand side, we've already talked about education, but a very similar story. Teachers and professors have resisted online education, preferring the classroom model that they grew up with and that they understand. And today, as we sit here, every university student and every high school student in America and in Europe is learning digitally because they have no choice. How much of it will slip back to the past once this pandemic goes away, we'll have yet to see. But as far as we're concerned, the fifth era is going to be a world in which these types of practices are the norm, not the exception. What does that imply for the corporate model? As investors, this is of great interest because the public markets are almost all comprised by equity of large companies and old companies. These companies almost all grew up in the industrial era, and they're designed to be very good at delivering their products and services through that model. And they do have certain assumptions built into them that took a long time to form. The 40-hour week, as we talked about, the notion of the specialization of labor, for example, in the bottom left-hand corner, the notion that secretary pools would be very good at doing one thing, typing up information, or the cube world in which people would collaborate in cubes and work together. This is a picture of HP, which made that famous. All of these assumptions may be undermined, and the millennials in particular, the digital natives, increasingly want to avoid this, working for the man. And in fact, there is a wholesale movement today where the digital millennials are much more interested in seeking out authentic ways to keep themselves busy in smaller clusters and communities. So we do think this is important. It doesn't mean that all large corporate companies will go away, but we think the balance between the private markets via the public markets is definitely going to tip much more in favor of private enterprise going forward. And that, of course, is seen in investment returns. So this page, which shows the 25-year returns for different asset classes, already demonstrates this to be true over the last 25 years. The fixed income and bond markets have been returning about 3% over the last 25 years. When you add trillions of dollars of new fiat currencies in a very short period of time, there is a good reason to believe that real fixed income returns just went negative. But regardless of whether you believe that thesis, this is low returns. The public markets, which have averaged 10 or 11%, have relied upon a lot of their return for new technology companies that have entered into the public markets. And indeed, much of the uplift of the S&P 500 and NASDAQ over the last 25 years has been the wealth creation of the companies we talked about before, the Apples and the Googles and the Amazons and so on, that have driven those indices. At the other end of the spectrum in blue are the private markets, and foremost amongst them are the early stage technology markets, which have perhaps the highest rates of return of any asset category. And the reason for that is very simple. We're living in the middle of an era of unprecedented innovation, where every industry and every business is shifting, and the returns are accruing to the disruptors, just as they did in all of the eras that we profiled at the beginning of this webinar. Two other points that we want to make before we wrap up. The first is that without question, we are living in a very troubled time when we look at the Earth and the Earth's condition. Whether this is the result of the industrial era, whether it's being propagated by this new fifth era, or whether it's simply the warming of this climate as it goes, this Earth as it goes through its cycle, is a moot point. The reality is almost all scientists agree that in future years we will live on a much hotter planet. This is the NASA prediction that by July 2100, many parts of the world, pretty much all of the tropics and the equatorial regions, will be close to being unlivable, and we will need to have ways to live indoors for human beings to survive effectively in those parts of the world. And obviously animals and crops will suffer significantly if we don't come up with new technologies to enable those regions to continue to be habitable. What does that imply? Either we find a way of slowing down the warming of the Earth, or we should expect emigration out of those regions to the northern and southern poles, and or we have to learn how to live indoors. All of these things are threats, but also opportunities for companies and innovators that can solve these challenges. And then distributed innovation. This is a complicated chart that summarizes the innovation models of today, which are very reliant upon physical entrepreneurs being backed by investors through a series of cycles. Instead, what we're seeing today is the emergence of distributed innovation. And distributed innovation means that innovators living anywhere collaborate digitally and create new innovations and companies and breakthroughs and work together on those. Now, we feel like it's too early to say whether the traditional innovation hubs, the Silicon Valleys and Shanghais and Shenzhens and Londons, will be displaced, or whether we'll see them complemented by an additional layer of distributed innovation. But this is certainly one that we think is worth focusing on, especially as the world's most innovative companies are beginning to announce that they will support fully remote and virtual working in their businesses. Are these 10 issues assured? We've gone through each of them in turn, and our view is that taken together, these 10 points plus additional points that are in the book, The Fifth Era, we believe that they are inevitabilities and that we do face the reality of a fully digital world, and that for investors and for business people, this is an enormous opportunity, at least on the same magnitude as the arrival of the industrial era. However, we're not so sure that everything we've described is assured. We see three wildcards that could upset this equation. The first of them is the possibility of global balkanization, which is to say that instead of having a cohesive global economy, we will fragment back into several sub-economies. This is actually the map of George Orwell's world from 1984, in which he had painted the picture of three competing economies, that of Oceania, made up of the Americas and parts of other Australasia and parts of Africa, Eurasia, which was primarily Europe and Russia, and then East Asia, made up of China, India, and all of the other ASEAN nations. Whether or not this is true, I leave for you to think about, but there's no question that there are powerful forces potentially moving to break up our emerging global economy. The second is cybersecurity, which we talked about at the outset. The workings of a global internet are only possible if the technologies, the networks, the hubs of that digital economy can operate in an efficient and safe way. And so on the one hand, we have private sector bad actors who are hacking and spamming and breaching companies and data, and they are beginning to apply technology to do that in larger scale ways every day. But under this umbrella, we also have sovereign-backed cybersecurity, or cyber warfare, if you will, and clearly there seems to be evidence that that is also emerging as a greater threat to the internet and to the digital economy to which we are transitioning. And the third that we'll talk about briefly is regulation and the anti-technology movement. Without question, a digital economy has winners and losers, and those losers are people too. And if those people are losing their jobs and their ways of life and being destabilized, then we should expect them to not be happy about the innovations and technologies that have taken away their livelihoods. We're beginning to see this anti-tech movement make important strides, particularly where they can influence regulators, as they are in some parts of the world, to put the brakes on innovation. And we expect that this also will be a more powerful force. Whether any one of these three or these three together can upset our transition to this fifth era, we don't know, but they're very important to keep track of. Obviously, we could add a fourth, which we weren't aware of at the time of the writing of the book, which is the risk of global pandemics. And of course, that has also had severe impact, though our personal views are that, terrible as it's been, this global pandemic has actually accelerated the adoption of many of the technologies and innovations and practices that we've talked about over the last few minutes. So to summarize, we wrote this book because as investors, we wanted to understand the tailwinds that were driving us into the future so that we could invest more smartly. And our own investment thesis is very much driven by what I've just shared with you. We think that this book is worth glancing through because we've been given feedback by many other investors that it has allowed them to get a keener appreciation of what entrepreneurs are bringing to them and some of the opportunities that startups and innovations represent. So please go to fifthera.com/ebook where you can download a free version of this book. We hope you found that this webinar was useful, and we hope that you'll find it helps inform and allow you to be better entrepreneurs and more effective investors. Please share your thoughts back with us either way. Thank you very much.